Morning, everybody. Let me ping everybody else. We'll get started. I think ICT is streaming right now, so if you want to go check into that, feel free to. It's just going to be another 2024 lecture, so I'm assuming they'll just be talking about the 2024 model and some bias stuff, but if you want to stick around, I would appreciate that. I'm doing well, Maddie. How about you? So I sent out the daily bias morning. We'll start at the 4-hour because the daily is kind of a mess. 4-hour chart. We did have a weekly change in the state of delivery. Here's your weekly open. We had basically bullish price action up until Wednesday, and then we dropped with displacement against the order flow, closing below the 2 p.m. bullish order block on the 4-hour chart. So that to me would normally indicate if you have a 4-hour change of state of delivery, normally that's the market reversal that you're looking for. I'm thinking we have something similar to this, except it's just shifted over. We're tracing the premium, and eventually we'll move off of that. This is basically exactly what we were looking for on the weekly profile from models and reviews. Was that I can pull it up here. This is what I sent out on Sunday. Was this Wednesday high week where we dropped on Monday, which we got. Tuesday to Wednesday expansion, New York reversal. I told you when we're looking for that market reversal, it's going to be between Tuesday on London session and Wednesday on New York session. And we got it right in New York. We flipped and dropped. So I would expect that Thursday, Friday, I want to see a breach into some sort of discount array on the higher time frame, which would be that weekly sell side, be it SMT on, or even the current week sell side, which is this draw on liquidity. Go to the hourly chart. We've got that dealing range here. Obviously a bearish dealing range, so buy side, then sell side, trading up into premium. So I'm looking for a premium to premium IRL to sell side liquidity. And if you look at the 15-minute chart, where's our low resistance? Well, we have low resistance here. I would say, right, it's not super low resistance over here. It's not like we have stacked liquidity pools, so I would find it unreasonable that we reach up for this high. It being August, I guess that's a possibility. But I would favor just running back for this low resistance, market reversal on at 9:30, since we have 8:30 not creating any manipulation. So 8:30 expansion, I want to see a 9:30 manipulation, and then possibly 10 a.m. closing in this entire gap. But since it is a inefficiency on the other way, you could either see speed all the way through it, and then it comes all the way back up and retraces. But I don't know how much of that we're gonna have. We could see a high resistance liquidity move, then speed after we get that. But somewhat of a bearish bias this morning. Since we have 8:30 news, protocol would be an entry between 9:30 and 10 o'clock if we want to reverse. Let me check if we have SMT on those highs right now. We're starting to get some SMT there, which is nice. 5-minute chart SMT. Let me zoom out, see if we have anything other SMT. No SMT at the lows, which is good. We have no SMT at the highs either. So really, it's just going to be looking for intra-session SMT. It's not like we swept London low. I don't think on any of these either. London low there. Yeah, London low is intact on all of them. We also have low resistance on ES and on YM, which is normally a really good draw. So if we have slight SMT at the highs here, I'm going to count that. If we can get it, I think we just got it. So right there, you have your SMT. I'm going to screenshot this, send it over to predictions chat. And we'll see if we can displace. Obviously, if you're forming an inefficiency in here, I might take that short, targeting this imbalance. By the way, these red lines are not lunch. It is from 7 o'clock to 8:30, which I may start keeping on the chart now, just from his previous lecture. It's not something he specifically mentioned, but there was an old video that I found that I'll talk about it later. So here's the SMT. Let me mark everything out properly first. We do have an inefficiency forming. We also have this order block, the inversion on the 5-minute, change in state as well. And you have potential sibi here forming. So actually, right off the bat, we may have a short entry That wouldn't be terrible. We have all this low resistance liquidity here. If we put in the relative equal lows with this, I would think that's pretty high quality draw. From the order block, I would like to enter from. They're 40-ish points or so. So watch, if we form this relative equal sell side, it's normally a good sign. Let me take a look at ES. I don't like how lackluster this manipulation was, though. 930 really failed to see any clean movement there. Did YM do anything? Oh, so here's your clean SMT. You make it SMT with previous day high. Or that really just the PM session there.
Order filled.
So tap the order block. We put on those relative equal lows down here, which is nice. We got the sell side, and then obviously this internal range fair value gap here is going to have some sort of resistance through it, so we'll mark it out for the current time. Curious, what is ICT even streaming about? Let me pull this up. Never mind, I'm not watching an ad. So if we're looking at manipulation leg, since we have the SMT, normally you can take it from this leg, but we'll just go from here to here. Targeting purposes, target 2 to 2.5 lines up with the sell side around 7:30. Sorry, 7 o'clock. Also notice the 5-minute actually inefficiency starts here. So if you wanted to drag this to here, that wouldn't be a bad idea. I'm just going to put a line here. We did leave smooth highs up here. Let's take a look at ES. Yeah, those are a little too smooth for my liking. And the breaker's not really high quality. So look for how we react off this 5-minute inefficiency. We can get down to it. We do have this order block in here. Obviously the 5-minute inversion gap too. The order block's holding. 5-minute inversion gap is also holding right around consequent encroachment with the spread. At the present, is that considered CISD on the 5-minute? I'm looking at this order block here. It's really this 845 order block as a change in state. But yeah, this 855, if we close through that, that would be some indication of a change in state because this is a high quality order block, right? We have an order block here with a fair value gap. So I guess there's two things you have to look at. There's always a change in state of delivery on a retracement leg. So determining whether this is a retracement leg or an inefficiency or a reversal will be categorized by how hard we displace to the sell side, right? So if we form inefficiencies that are clearly being left open, like breakaway gaps, measuring gaps, just displacement, instead of it kind of lethargically moving lower and filling it quickly, then moving lower, then filling it a lot, then moving lower, then filling it a lot. That's not normally characteristic of a market reversal. Like think about what you saw with the 2022. It just reverses and then boom, it just goes quickly. So the way you can categorize retracements is by looking at on every single like down leg, if we're moving lower, does it just immediately refill that imbalance? Something like this, it kind of filled it back and forth, but we did leave some of it unfilled with candle bodies, which is something I'm looking at. We also did just run the sell side tap into the 15-minute inefficiency there. But I'm looking at discount of the dealing range, which would be from London session to current high. Premium to discount would be right around lunch, in between Asian and London high. But that's discount in case we wanted to drop there. The order block that we'd be referring to would be on the hourly chart probably. Yeah, right around the 3 a.m. order block. But there's your sell side. Let me close below that. You have a bearish order block here. I want to see it spool, preferably. Although we are in the gap. So the problem is, like I said earlier in the stream, this inefficiency. Whenever you have a large inefficiency that's counter bias, so if we have a bearish bias and we have this large inefficiency, you're going to see high resistance liquidity moves in that inefficiency. So that means if price wants to come down all the way to the sell side, for example, like maybe in here or the London low, a lot of times you're going to see high resistance, which is difficult to trade because you have internal range stop runs a lot of times and just deeper retracements on the up closing legs. One way you can look at the way you can spot a high resistance liquidity run is something like this. Yeah, some similar to this, but when you have a down closing candle range, normally you're going to use the upper portion if it's a bullish order block, right? So notice how we're kind of coming all the way down to the last down close instead of just using the wick with the inefficiency. Last down close. Trades up, move inefficiency here, it comes all the way down to the last down close. Here, this is an expansion leg up, but I'll try and find a good example later on in the stream and I'll point it out to you guys. But we've been holding the bearish order flow really well. And I would like to see some sort of a measuring gap or breakaway gap form as we're leaving this area of consolidation. You can see the 5-minute structure is holding really well. And I do want to see this bisi tagged here and the even discount of the range, which is slightly further than the premium end of this imbalance here. So news protocol normally can save you on this one. Entry before the macro time as expected. And just trading towards the bias as soon as we got everything in line. I'll see this 1 minute just run through. There we go. So I'll send the trade execution. I do think we'll reach lower, but I'm going to screenshot this, especially after the loss yesterday. I cut risk looking for only just a recoup of the loss. So there's the execution posted in. Pretty standard stuff, I hope. So I'm hands off now the rest of the morning session. Let me close this out. But looking for lower prices still. I'm looking for London low as a draw on liquidity. Okay, let me screenshot this really quickly. But this is where you could see a short-term bounce back into premium. But this, like, if we can leave some of this open, which I don't think we will be able to, but if we can leave some of this open, that would be a good indication we're starting to reverse. All right, so now that I'm out, I can focus a little more on just the tape reading aspect. So if you've been keeping an eye on the 2024 mentorship, ICT talks a lot in the first 2 episodes. I didn't get a chance to watch yesterday's episode, but just skimming through the first 2, he talks a lot about your relative equal highs and lows, which is something that we focus on in the form of low resistance liquidity, like seeing something like this. He focuses more on those low resistance, you know, what's the closest kind of equal lows or equal highs. And it's something that you can use in bias, but I want to emphasize, if you've been watching that, there needs to be some understanding of why we're going to get down into that, right? I framed it today based on a 4-hour chart, based on a 1-hour chart from IRL to ERL, but there has to be context of why we're going to run out that low resistance liquidity or the relative equal lows. It's not going to be an everyday thing where you're just going to see the smooth highs and then boom, that's where we're going to target. It's not true. It works like that. Here's your macro time and efficiency in here, which is nice to see, especially if you can leave that open. I think we'll get down into it. Yeah, and then okay, I didn't mention this. Let me talk about this as well. Your New York Open kill zone, is from 7 a.m. to 8:30. 7 a.m. to what? 9:30? Now I'm confusing myself. I think it's 7 a.m. to 8:30. But let me introduction to ICT macros. So if you go and watch the 2023 mentorship video, okay, I'm getting added. Let me mute this. He talks about the importance of the New York Open kill zone and then the New York kill zone. Let me look at the difference really quick. So you have the New York Open kill zone and the New York AM session. The New York AM session is what we're commonly referred to in the indices, right? Between 8:30 and 11 o'clock, or really 8:30 and 12 is that entire range. And the New York Open kill zone is between 7 a.m. and 9 a.m., where you can see that high and low put in. So, and he talks about in this mentorship as well, where 7 a.m. kind of starts that New York session. So marking out the 7 a.m., in this case, I kind of switched this to 7 a.m. to 8:30. I might switch it to 7 a.m. to 9. But using that entire range as now a added confluence of draw on liquidities could be important. You could obviously go back and look at how many times we've kind of ran that out. So using something like this, just marking out the 7 a.m., I'm going to probably start doing. But yeah, he talks about having consolidation as well, which is evident normally when you have a market maker sell model or buy model. So if you have the low resistance liquidity, relative equal lows, you have areas of consolidation as well. It's normally a pretty good sign that we want to return down into that. I want you to also spot and go in and back test. When you have something like a London low or London high, make sure there is low resistance or relative equal lows or highs that are in close proximity to that swing point. So in this case, we do have, look how we have this London high and then relative equal highs and low resistance all the way down. We're going to use that as a target. Same thing here. you have low resistance with the relative equal lows put in there. That's why I was favoring. Obviously, I'm favoring a draw really down to the weekly sell side, but that was the short-term draw. So here's your macro time. It is possible to come all the way back up into here because now we have the relative equal buy side. And I'm going to look for the SMT. We do have slight SMT with YM. Not slight, but SMT there with YM. And if we're using the open low high close of the profile, I want to see how I react to this internal range liquidity here on the hourly chart. But look how 930 failed to manipulate above here. And we're now disrespecting some bearish PD arrays with pretty large expansion. Where's the 5 minute? You need to see the 5 minute order flow now. No inefficiencies up in here. Look how, so remember I was talking about the retracement leg. If it's a retracement, normally you'll fail to see any displacement through where there's just gaps being left open. Notice how here, this is not a retracement leg. This is just an expansion. But in here, if this was a reversal, I can't speak, there would be 5 minute sibis forming. Look how we open, wick around, open, wick around, open, completely refill that gap, come back down, open, fill that gap again. And then now, what do we see? Quick expansion away. So to me, this looks like a retracement leg possibly down into this inefficiency. And we're going to start to reverse during macro time, back up into the relative equal highs. And if we have external range liquidity, we don't. Unmitigated fair value gap in premium on the 15-minute chart would be the next draw. So I'll mark this out. The macro can either reverse or continue. It's the two functions, okay? The two functions of the macro is either to reverse and it's going to seek from inefficiency. So we'll say the value gap to liquidity if it's continuing. So we'll say IRL. No, I'm not going to say IRL. We'll say, yeah, for value gap to liquidity if it's continuing. And it's going to go from liquidity to, doesn't always have to go from liquidity to imbalance, but liquidity, the reversal could be anywhere, to be honest, so I'm not going to label that. How do you distinguish between the two? Well, if 930 created a strong market reversal where it's left something jagged and there's a reason for us to form an open high low close, then you'll have a macro continuation towards the drawn liquidity. If 930 fails to form any meaningful manipulation without SMT, then you look for the macro to reverse and then purge into 10:30 to 11 o'clock. It's always going to be into 10:30 and 11. Sometimes you'll see that on 8:30 news days, we can reverse going into a little bit earlier than that, just because 8:30 will start that kill zone. But in this case, what am I potentially looking for? Well, 9:30 failed to manipulate in here. We do have SMT on the lows, that on the higher time frame, which is what I was favoring. I don't like this tiny little SMT there. Larger SMT here with the 845 low. It's not a data low, but just notice how we're expanding up from here. We're expanding away from this inefficiency. We disrespected bearish PD arrays on the way up. And we left relative equal highs up here. So I think it's possible now that the macro will reverse, create an entry opportunity back up. I'm also watching this reclaim for value gap. But to be honest, we have no reason of reaching back up into here. So we have a potential 1 minute breaker forming in there. Do you try to sync 5 minute order flow with 1 minute to frame entries? Yes, all the time. 100%. The 5 minute order flow, if you think about it, 5 minute order flow is like the lower time frame chart. Like in all of his mentorship, and he talks about it, the 5 minute order flow is like the lowest time frame you'll use for like a scalping kind of profile. The 1 minute chart obviously is available and it has more data than is needed, but the 1 minute order flow is so minuscule compared to everything else, like a 1 minute chart. So using the 5 minute order flow is paramount to finding any high quality 1 minute trades. When you see that you trade counter 5 minute order flow, it's really, really difficult because there's so much. If you're using like 1 minute CISDs, there has to be some, you're basing a 1 minute CISD off of a 15 minute PD array. So there's always something above the 5 minute. So yeah, I think you need to look at the 5 minute. I always have the 5 minute pulled up. I used to have this as the 15 minute chart a couple months ago. I switched it to the 5 minute because this is the most important when you're looking at lower time frames. And obviously the displacement is going to be paramount too to finding good trades. If you have displacement on the 5 minute, that's normally going to give you telltale signs. So like if we start displacing here in silver bullet hour to the upside, then you look for premium arrays. Today's ICT lecture was just about new day opening gap and new week opening gap. Oh. Let me put on the new day. Is there no new day opening gap? So look how the macro time created the reversal function. Let me turn this off now. Create the reversal. Are we likely to see a reversal after that? No. Your profile is open, low, high, close. In this case, 930 open is here. So once we start expanding past this buy side, now we'll seek further premium. So if you go back to the hourly chart, you have this in like inefficiency next. Really, you could be looking for right here. The problem I have with this is now a breaker, and I still think that the draw on liquidity on the higher time frame is bearish. Obviously, you gotta still go with what's given. But I think the smooth highs will be ran out, and then after that, it's really just up to whatever. I'm not too concerned with anything. Already. Oh, I'll extend it. My bad. Oh yeah. See, I would use them, but I realized that it's just too. It's a little messy. Like there's so many. There's like you're supposed to extend the previous 8 new week opening gaps and the previous 8 new day opening gaps. So it's like think about how many different gaps you'll have. Plus you have to probably mark up the event horizons of each one, which is halfway between 2 new day opening gaps or new week opening gaps. There's your 930 liquidity pierced. So 950 macro reversal. Would you classify today's open as a double Judas? I wouldn't. That's a good question. I would say since this 930 really failed to manipulate higher and we had a very slight Judas swing, I would say that the fact that if you were able even to capture any shorts, it is slightly lucky. Not really lucky, but like this kind of notice how this manipulation on 930 was very lackluster. It just opened, it just kind of stayed within the range, barely took out that high. Think about what we normally see with the 930 manipulations is going to be some sort of an animated run. So something like this is now an animated run lower, and then you have an expansion up. So I don't think, it's a good question. I don't think I would classify this as a double Judas. So like if you're familiar with the profiles, something like that what is it, theta or beta setups, I would classify this as just really just as a deep retracement. You then look for expansion up and macro reversal. 956 would be a valid entry. Why? Because we now are trading within a breaker. So we don't need to see discount run. Right? We have a bullish breaker outlined here. CISD. So then that would be a valid entry opportunity long if you're looking at this for value up there. And we're flipping this as inversion. So your order, by the way, if you're looking at reversals in price, the way you want to be looking at reversals is just kind of steps to it, right? So you'll have the turtle soup, obviously. You'll have a short-term change in the state of delivery, which I'm looking at this very bottom range. So if we're bullish, this very, very last down closing candle, okay, will serve as a change in the state of delivery, right? Like if you just have move your chart all the way to like here, and that's all you saw. Say we're just trending up and there's your down closing candle. See how now it kind of serves as, once you close above it, the candle buyers are now staying within that CISD. So that's your first change in the state of delivery. That's why it's change in state of delivery technically has two purposes. This one, then the secondary function is the breaker, which is the actual closure through a bearish order block. So two change in states. So turtle soup, then CISD, then normally you have an inversion fair value gap that is traded through. Then you have a breaker that's traded to. And then obviously you have everything else after that. But like in the order of when they form, if you're looking for a reversal, it goes turtle soup, CISD at the low end, then an inversion fair value gap, then a breaker. So when you see all of those, look at how many times we form. And obviously if we're tracing, and you're going to see less of those, that's clear because we're forming something like this. So I want you to notice between these two legs, if you split this market maker buy model in half, right at the turtle soup. Let me go to a clean chart. You split this right in half. Look at how many fair value gaps here was completely filled, or how many we formed. So starting from this point, how many fair value gaps do we have? Sibis, specifically Sibis. If we're bearish, you're always going to be looking at those Sibis. We have 1, we have 2, and we have 3. Okay, 3. Out of those, how many were instantly mitigated? 1 in here. The candle bodies were closing below, which is actually a good sign. And here, we instantly mitigated that. Here, we left it open. Then on this side, how many fair value gaps were formed and just completely left open as well? You have 1, you have 2, barely touched there. You have 3, you have 4, and you have 5 already on this range. And notice how we're just kind of forming them, failing to have any retracement back in. Here, we're just slightly dipping into it and then running away. So this should show you where's the energy in the market. Well, the energy in this case is to the upside. So this is how a retracement looks. This is how a reversal looks. And reversal will normally have expansion after. So we had a bearish bias, and I was looking for at least discount of the dealing range for us to retrace into. I would find it unreasonable, right? Because if we are bullish in the morning session, say the bias was wrong, right? Say my bias was wrong, which I actually think it is wrong. I don't think we're going to reach into London low. You'll still have an open to low, then the high close. Does that make sense? So now we were trading, or at least me personally, I was trading this part of the leg. And now others are probably going to be trading this part of the leg, which normally you do want to be trading this expansion, right? Because that's going to be the one that's going to have the most energy, and it's going to be time-based and all the other stuff that you normally have learned. But that doesn't mean that you can still trade. You can't still trade this range. If you think about it, a daily profile, both sides of the market have to go. Sell side and buy side have to go. We have to return into premium and discount. It's not going to just go to premium and then premium. So if your bias is, okay, I'm still thinking it's going to return into lower prices, then you trade that first leg. That's why on 8:30 news days, especially, right when I started the stream, I mentioned 8:30 news profile. You have allowance to trade between, at least for me personally, I have an allowance to trade between 9:30 and 10 o'clock. I don't have to just get a macro entry, which normally is the thing that keeps me safe, and it gets me out of these kind of sloppy Judah swings. Obviously, the expansion in this case is still within the macro time. You could probably still reach it up into 10:30, maybe into the new week opening gap. I still think that's really weird. Like if you look at the higher time frame profile here on the 4-hour chart, we worked into this new week opening gap and then boom, left it. Why the heck are we returning up into here? Like I don't see a reason, especially on the 1-hour chart since we have this breaker. Like touching this new week opening gap, premium discount end, which would be the premium end of this breaker. I just think that's weird, which I guess that's characteristic of August. Like if you look at last week, seeking to short profile to the T, buy side, sell side, buy side, sell side, nasty price action. And next week, I guess we do have CPI, but that really shouldn't be affecting weeks in advance. It's just a little weird. But hopefully this can point out to you the characteristics of retracement and then a reversal, which leads to expansion, right? If you think about your stages of price delivery, consolidation, expansion, reversal, or retracement. 4 things price can do. Only those. So if you wanted to make a model, say your model was the 950 macro, maybe some people are even here just because of that one video, where it's the stages of price delivery based on a model. So if you have a model that's maybe market maker sell model, or it's like some time-based model, you have to have 4 kind of entry opportunities. Anyways, once you spot these, it's easy to characterize. Consolidation, expansion, market reversal, or retracement. Go back and watch that video. I don't even understand all of the different characteristics, but it is a really high quality video. Let me go to, there we go. In ICT's lecture yesterday, he mentioned he recommended focusing on the last 5. Okay. Back in 2023, it was 8, which I guess there's no reason to not narrow it down. But yeah, if you're going to use a new week opening gap, new day opening gap, then last 5 to 8. You don't need more than 8. IC talked about using new day opening gaps for 5 days and but yeah, that can make the chart messy. He also talked about price having tendency to move in the direction of the cluster of new day opening gaps. Yeah, it's like, it's something that you have to just use if you're going to use it at all, in tandem with everything else, right? Like new day opening gaps are nice, but then you also have to realize you can't just use new day opening gaps. There has to be some sort of liquidity there, or there has to be some narrative. You're not ever going to not use narrative. So for me, it's like, yeah, they're there. Like something like RTH gap. I don't use RTH gap all that often. I think it's useful in its sense, but I don't incorporate it into my analysis of then adding a draw on liquidity. Your goal is to make this simple. Your goal is really to learn everything you can, figure out what you use and what you don't use, and then make it as simple and as a robotic of a process from daily bias to entry as you can. So you eliminate the variance that comes with emotions. Right? If you're trying to trade something new every single day, think about how difficult it is going to be to manage your emotions. When you're trying to trade something new, you're trading a new position side, you're trading a new kind of entry technique, it's going to be really hard. So when you make it simple and you use the same stuff, and maybe new day opening gap and new week opening gap works for you, but you can't just be switching just because he's starting his 2024 mentorship. Do not instantly just switch over to new day opening gaps and think you don't have to study it. Just because you see the new week opening gap or new day opening gap in your chart doesn't mean it's going to draw to it. He's doing introductive things, so no real limit of 5 is just a good starting point. You mentioned keeping them for as long as you want, actually. Yeah, but then, like, I'll give you an example. Like, if I pull this up, and I put the last 8, plus I have the previous 5 new day opening gaps, and I extend all of these out. If you go to the 15-minute chart, someone's going to see this and they're going to be like, bro, what the heck am I looking at? Like, especially when you're new, you're going to be like, I have no idea what's going on. Or maybe you just been looking at this range in here. And then you have to maybe mark out the event horizons of the new week opening gap, which would be the 50% between discount of one to premium of the other, which would be like here. And now you have an event horizon here. But all that stuff is... Let me turn this back off. So yeah, I mean, in this case, obviously you do have this gap. Where's the premium inefficiency I had? Then I mark out the 1 hour gap. Oh yeah, up here, which you're trading into right now. We still have about 15 minutes left till the expansion should be done. Right in there. Right now, I have 16 new week opening gaps on a separate chart only because I have a cluster of them from the original consolidation dating back to April. Yeah, keeping them on the main chart is definitely... That's why I just have like at the most, I'll have the current new day. Sorry, the current new week opening gap. Especially when it's large. The only time I'll use new week opening gaps is if they're more than like 15, 20 points. I mean, this week was just utterly insane with 115 point new week opening gap. But like if you go back to last week, it was very, very tiny. Right in here. Like this is not a usable new week opening gap for me. So now we're expanding. What do you expect with order blocks? They should hold. Only reason they shouldn't hold is if we're tracing into a short-term discount. So for rally ups, all in here, lining up. Remove this. And obviously you're trading into an hourly gap, but you could be looking for a new week opening gap after that. But obviously it doesn't matter where on the price we form the high. You know, it has to reach into either a 15-minute or 60-minute PD array. And normally it's going to be between 10:30 and 11 o'clock. It's going to be the end cycle. So if we reach into the hourly gap, that's fine. If we reach into this new week opening gap, that's one thing. If it just completely disrespects the new week opening and keeps going higher, that's why just timing it will be important. It's time first, then price. Just got filled out. This NQ just runs. It does not care. I know, man. This is actually crazy expansion up here. Starting from the macro reversal. But if you go back to all of your macros, all of your 950 macros, look at those two functions. It's either going to continue or it's going to reverse. The times it continues, you normally see a 930 Judah swing that's clear, obvious, has SMT. The times that the macro reverses, you have 930 as a lackluster Judah swing. Normally leaves relative equal highs or lows in relation to some other time-based array. So if for example, 930 fails to run out the London low and creates relative equal lows, then the 950 macro into 10 o'clock, I would expect to reverse. So then where would you find an entry? Normally, if the macro is reversing, the latter portion of that macro. Okay. You'll find an entry there. If we're continuing, you'll see that normal 952 to 958 kind of sweet spot within the macro to find a continuation entry. That doesn't mean you can't find an entry still within this time if we're reversing, which we still have one here. 956, you got an entry. But if we go back into price, I'll quickly find another example where the macro is reversing. Yesterday was a mess. Here's a continuation. But what do you have? 930 creating a nice run on stops. So the macro is going to continue. This is similar to the one we got yesterday, but I'm trying to find one where it's like blatantly obvious 930 puts in the relative equal low. Anyways, I don't think I can find one. Chart is lagging too. Oh, here we go. 9:30 opens, lackluster manipulation, right? It's not an animated move. This is an animated move, not this tiny little box. This is not really manipulation, okay? And we didn't do anything at 8:30 that would qualify this as a continuation. That makes sense. So fails to run out London low. We have relative equal lows now. Notice the low resistance liquidity over here too. Trades up, macro reversal. So you're looking for preferably after 10 o'clock, the later portion of it. Why would you look before or after 10 o'clock? Because the whole opening range would be between 9:30 and 10. So if you want to see the high put in and we're looking for the reversal, then it's going to be after 10 o'clock. So it's going to be 10 o'clock to 10:10. You want that high to be put in. You want to allow all of that range to be put in. You don't want to be looking for a macro reversal in here before it could be, before that time-based high is put in. So now the time-based high has been put in. We see a market structure shift. We see inefficiency in premium. There's your entry. And then we do have a secondary entry in here. Tapping the bearish breaker. So it just need to return into premium. And then it wilts back lower anyways. Now notice the 5-minute chart. 5-minute chart is expanding and leaving inefficiencies in its wake. So I would assume that I want to see that new high put in. It is possible that we do retrace back into this bullish order block. So the 9:30 opening candle, and then this inefficiency that lines up right below it, or right above it, right in there. So I think it's possible we could retrace into this low resistance first, and then come back and put in a new high. Let me screenshot this really quickly. Notice how there also wasn't really a deep retracement anytime within this leg. We just kind of been expanding. So I would look for a retracement. I don't think we'll reach all the way to back into discount. I would favor just this up closing candle holding this order block, or the order block holding the fair value gap here, right at the 9:30 open. Like this gap right here. So here's the pretty obvious SMT, I think. The 9 a.m. lows. We do have SMT still at the highs. Just framing a short setup. $10.17. Still a draw on price. The weak opening gap I would expect is the PD rate we're going to reach into. But this is a beautiful just open low manipulation expansion into the time. There's your entry. So when price, another tip for the macro, the 950 macro, the two functions, continuation and reversal. If we're reversing, it's going to be the low risk buy or low risk sell. If we're continuing, normally it's going to be the second stage of distribution or reaccumulation in the market maker model. In this case, the macro actually served as the purpose of the second leg in the higher time frame. So if we zoom out, the macro here is being used as the second leg in this market maker buy model, or even on the higher time frame one of this one. This is definitely one to screenshot. Like I said, go back in tomorrow or go back in later today. Screenshot everything. Daily 1 hour 15.51. I'm curious to see, did we reach into discount of this range? We did. Nice. Perfect. Beautiful. Well, this is something where it's like, you know, if you're wrong, for this example, I was looking for a retracement down at this bisi and then a movement back up. If it doesn't do that and it just forms a new high into here, that's where you can be wrong and still be, the market still moves in your favor. Also, we're failing to run into this order block here. So look for a turtle soup on this low. Actually, we did tap the wick. Never mind. When you see retracements that fail to reach order blocks, that's where you get deep retracements and stop runs. Okay. So look at where your fair value gap is relative to the order block. Most times you're going to see when price retrades into a gap, it's reaching some sort of a order block. That could be a breaker, that could be a mitigation, it could be a standard order block. You know, all your different classifications of order block, but just an order block. So if the breaker is there, that's going to reach into that. Something like this, you can see the wick there being tapped into. Very rarely does it just reach into an inefficiency and then leave it without tapping an order block. In this case, you have the breaker. I guess this is a mitigation block. The mitigation block in here, on the higher time frame, that's what it's reaching into. Plus it's dropping to discount. Plus it's filling the inefficiency. So when you have price, say you have a range like this, where it's down closing candle range, you have the inefficiency, and it reaches right into here, and it doesn't reach any other order block. Then what you could expect is that low to be turtle souped. It trades down into the order block, and then it creates the real expansion. I hope that makes sense. It was outlined, I think, in like, someone screenshotted it and put it in, was it models and reviews? Someone put it up in there? Yeah. YSMF put one in. It's this image. So if you're looking for internal range turtle soup setups, this is the screenshot that was posted like last week or 2 weeks ago. So there's your new high put in. We're still looking for 3 more minutes of it, of the expansion, reaching the new week opening gap. 10:07. No, that's a good question, but notice how we're reaching into this order block here. It's a low quality order block, meaning there's not a thick candle body. So what are you going to take? The entire wick, the wick to wick, reaches it there. That's a good question though. If it's obviously one of those thick candle bodies like this, boom, you're going to be taking that entire, that up closing candle right there. Not the up closing candle, sorry, the open right here. In this case, we just reacted just to the wick right there. So price is extremely bullish if we're just reacting to the wicks. I think it's possible we could turtle soup this low. It's likely we could see a soup on this, and then it comes back up. But like I said, this is where a point where as soon as we make that new high at 10:30, I don't really care what happens after that. Yeah, I would like if we got something like that. But notice how there's no inefficiency next to this order block. See? It's pretty clean. We have this one in here, but it was completely mitigated, and now we're leaving it. We took out this short-term high. So preferably not this fair value gap And really, this order block wouldn't be reached into a secondary time unless we were tracing back into a discount. That's all like really, really advanced tape reading tools, where like, you know, the opportunities that it happens on is so rare. So like having it in your back pocket is going to be the only useful thing. Looking for it every single time is not going to be useful. Like there's kind of like a pyramid of like tape reading tools. Like you're at your lowest part, you have the base stuff, which is your value gaps, stop runs, market structure shift, all that stuff we taught in 2022. Then there's like advanced tape reading stuff. Exactly. Law of diminishing returns. Where there's going to be super, super rare PD arrays and what's it called? And just like tape reading tools where it's going to be like, there was such a rare occurrence. You know, you may only see it once a month or twice a month. Look what time we're reaching up into this. Isn't this just beautiful? Time and price. New week opening gap reached right at 10:30. Let me darken this a little bit so you can see it, hopefully. That's a little bit too bright for my liking. You get the point. There you go. This is why 8:30 news days are preferred. This is hopefully you've seen if you were here yesterday. This is what high probability looks like. Okay, able to scalp both the downside on the open to low, and the upside to open to high, the low to close. Time and price lining up. You have the drawn liquidity, the 15-minute or hourly imbalance being reached right at the specific time you want to see reached. So it's like now at this point, here's your 10:30. So now it's like you don't even need to see a new high after that. Right? Everything else is extra. If you were still riding onto something, holding onto some runners, good, really, really good opportunity to take partials. Like if I was in a position long here, I would close it out instantly. Everything, 100% of the position in demo, obviously. And look at the displacement we're getting on the 5-minute. Clean, just leaving inefficiencies in its wake. 15-minute chart too. Yeah, that's just beautiful. Huge inefficiency there. You get a feel for the market once you have seen the same stuff enough. Exactly. That's why like some of this stuff is experience. Like the specific gaps or the specific order blocks that I mark out are just because I've seen it enough times where, you know, someone new coming in would be like, okay, why did you mark that out? Especially with order blocks. Order blocks was something that I found really, really frustrating in the beginning. Like whenever ICT was teaching order blocks, I'm like, why is he pulling that one? Why is it this one instead of this one? Why is he not marking out this as an order block? But that's something that's directly taught only through experience. Like you can't teach it any other way. Fair value gaps, boom. You know, it's really easy to spot it. But then the part of experience related to fair value gaps is which fair value gap is going to reach into. That is more rule based for sure. Like this inefficiency being left open as a breakaway gap because it's an inversion. You also have an inefficiency here placed on top of a breaker, so it's not going to reach into a discount. This being a breakaway gap, same thing in here. You have a breaker on the 5-minute chart, so this is going to be a really shallow run. But listening to someone using certain things live is the best way to learn it. Yeah, that's why I think like that's why I don't try and trade on this screen because I think it takes away from the actual learning, right? Like if I put on 5 minis on a trade, 90% of the people are going to be looking at that trade and looking at the stop loss and looking at the take profit and just be watching that P&L right over here. Their focus is over here on that stupid P&L. And then you lose the value of actually watching price print, having a drawn liquidity beforehand, how it prints to get there, looking at precision elements like time, reaching right at that PD array, right at the specific time you want to reach it to. That's the stuff that when you have a position on, you're not focusing on that kind of stuff until you've seen it enough, where then once you're in a position, you're trading with that bias. And everything that you see is has to be efficient. It has to respect this PD array. It has to do exactly what you are expecting it to do. And if it doesn't, then you can now manage your stop loss. Then you can now close out the position maybe before it reaches a stop loss, because you already have a general understanding of what price action is likely to do. But now this is where, you could see the retracement. And I hope you understand that, this is why it is August. But if you're going to focus on high probability days, 8:30 news days and non-news days, obviously not before an 8:30, is it going to be high quality. So compare and contrast this price action to what we got yesterday. And going into the week, you scroll up on the daily bias section. What did we expect? Pretty uneventful week. Probabilities is as follows: high Thursday and Tuesday, medium is Friday, medium to low would be Monday and Wednesday. So when you understand the economic calendar, it's really, really easy to just walk away and expect poor setups. Obviously, yesterday I did take a loss. I think it was a really difficult trade. And in hindsight, obviously, having that understanding of, we're already going into the morning with the expectations can be low probability, trying to scalp even from this inefficiency up to that short-term high and missing it by 0.5, like literally 2 handles, missed the take profit. It's part of it, but that's why you don't want to put yourself in positions where that's going to create some sort of emotional response. Think about if you came into that day with an expectation of maybe you had to get a daily profit goal, which I hate daily profit goals now. Maybe you go into it with like, okay, I'm going to make $700 today. And then you miss your take profit by 2 points. If you have that expectation and it's the reality between the expectation and what actually happened, what do you think you're going to do? Maybe over leverage, over trade. And then boom, your account's gone. So avoiding those situations and just looking at the economic calendar. The economic calendar tells you where your setup's going to form, what time it's going to form at. 8:30, we know our setup, or at least my setup's going to form between 9:30 and 10. But that's the stuff that comes from just actually doing the work. If you don't screenshot every day, if you just show up and tape read and then go about your day and not actually screenshot the charts after, you're missing out. Do you buy NASDAQ in the long term after a crash in order to profit after a bigger retracement lower? I believe that might make sense to buy with lower leverage. Obviously not the future. Oh, you mean like just like the stock? It's not a bad idea. The only problem I have, if you want my insight, obviously this is not financial advice. Do not take this in any form. It is just my opinion. But if we look at, let's go to NASDAQ really quickly. I want you to notice, me and Elijah Pips were talking about this in a call, but it's possible, if you look at this monthly dealing range, we have this inefficiency. And it lines up right with this order block, right at discount, and it's an inefficiency here. It's possible that we come down into here and then trade back up. And that's really going to be determined with elections. And if you've been watching what's happening around the world, we're kind of entering into a period where there's going to be heightened volatility and it's going to be difficult, right? You have a lot of things. You have the war in the Middle East. You have whatever the heck is going on in the UK. You have inflation being an issue. You have economic problems. You have the election. So a lot of stuff that can instantly, I'm not saying that directly has any impact on buying and selling pressure. I'm saying that heightened volatility and the manual intervention that can come in with those kind of events is possible. So if we were looking at something like the monthly and the weekly, you have to have frame a swing trade. So it would be, if we bounce out of this and you have maybe like a weekly or a daily change in same delivery, then you could look to buy and reaccumulate your orders for whatever Roth IRA in demo. I think you have to have a whole different model if you're going to buy on long term. You have to have understanding of seasonal tendencies, monthly influence, weekly. I would say you could wait for that fall low waiting for the actual seasonal tendencies is going to be important. Notice how we have a shift here. This is characteristic of a seasonal tendency. September, October, right in here. And that seasonal high, I think, is put in during springtime most times. Here you have a seasonal high. Here you have a seasonal high. Obviously, we got that 2022 crash in quotation marks. Something that's clean though for long term with seasonal tendencies is oil. Oil is like, for whatever reason, really, really clean most times. On a year-to-year basis, obviously you're gonna have points where something like this, where it goes into the negatives. I don't know if you're never seen oil before, this is probably one of the weirdest things you will ever see, is when oil went into the negatives by about 40 points. So if you've never seen this before, here's your little tidbit for the day. Oil went negative after the crash in following COVID. Anyways, we're just digging up into that inefficiency. But for me personally, I'm not really invested long term yet. I think I'll focus more on, once I get the capital at a manageable point, I'll focus on real estate and then maybe like private equity, like investing into other people and other firms. I like being liquid on something like this, especially when we have a skill that we're refining down for lower time frames, where you could go in on specific days and just hunt setups. I don't like having, me personally, I don't have that kind of, not guts, but like it's just uncomfortable when I'm in a position like for weeks and months and I know, okay, it's likely to drop here, but I can't sell. I have to anyways, whole different conversation. See you, Tally. I don't know if he's still in here. I missed that. Good stuff today. Master Ugo spilling sauce. All right. Yeah, they didn't pay you for buying the oil. It's just really weird. I don't actually know what they did. Yeah. If you're going to go long term, don't ever use it. Obviously, not financial advice, but using something like options and futures is just, I think, kind of stupid if you're going to do long term, just because of how much leverage you're using. Options also you have theta decay, which is just, it's the stupidest thing. I don't understand why anyone would trade options, to be honest, when you have futures available, especially only if you're trading SPY and QQQ options. That makes no sense to me. If you have like a availability to a prop firm or futures, like dealing with theta decay, like, yeah, you have more return, but then there's so many more factors that influence option premium. You have theta, you have VIX, you have gamma, like all those Greek letters that I learned back in 2020 and then never used. It's like, options do expire as well. Yeah. It's really, the only really use you have for options are for hedging purposes, like the actual use of options. Like trying to gain any profit off of option premium is just tough. You got to either sell options and, maybe with covered calls or something like that, or you have to actually just hedge a position. Like using put options in this case with the market would not be a terrible idea to hedge your long-term position. Yeah, but you could also, exactly, you could use futures. But then you also have to have more margin, I assume, holding overnight. Anyways, we're just kind of getting to a yap sesh here. So there's your entire morning session. Pretty is like extremely textbook. Open, low, into a discount, in a fair value gap, back up to the high close in the expected time window. Macro serving as a reversal and giving us a breaker entry, which I did not utilize today. Decided to go short off the inefficiency here into the relative equal lows and it's the inefficiency in here. trade is posted into future trades if you want to take a look at that. My main goal today was really just to get out of drawdown from yesterday. And if before I leave, if you're not managing risk, that is of utmost importance. So using something like the same risk every day is not going to be beneficial. You need to understand. I basically have like 3 different risk tolerances per day. Like there's going to be a low risk, medium risk, and high risk, and a fluctuation of that. And it's both determined on drawdown and determined on market conditions. So like yesterday, I went in with a little bit lower risk, knowing that it's going to be difficult and it's potential I was put into drawdown. Took a loss after that. Today, went in with even lower risk because now I'm fighting against drawdown, and you have to stop the bleeding, which is a really good analogy that ICT teaches and CJ Trades teaches, where you have to, stop the bleeding at some point. And the only way you can do that is by lowering risk. And your goal is then just to target basically 50% of whatever you took as drawdown. So if you took $1,000 as your risk, took a loss, you have to then drop to whatever that risk allowance is. Maybe it's 500, and you have to make back a 1-to-1, and then you can go bump back up to that risk. But I'm telling you, those lectures and the speeches that he talks about on the Twitter Spaces, you just have to listen to. The only way you listen to it, or the only way you actually figure out if he's wrong or right, is by going in and then getting hurt, and you're like, all right, yeah, he was right the entire time. So don't take the painful and long way. Just do what he says, and I promise you it works. It's not like he's, gatekeeping anything from you. It works. So risk management is extremely important. Now tomorrow I have the opportunity to potentially go back to my normal risk allowance, or just not take a trade, because to be honest, I'm fine with not taking a trade tomorrow. It's Friday. It is what it is. I've already gotten my chunk of the week. But that's you have to have some sort of implementation of that. If you don't, you're going to lose and you're going to fail. That's just the reality of things. As soon as you think about it, you're one trade away from your biggest loss. Not your biggest win, your biggest loss. All it takes is you to get emotional, click a couple buttons, and then boom, your account is gone. So you have to have some sort of protocol for after you take a loss, after you take a win. What do you do? How do you scale? How do you have a risk? What's your daily max allowance of a loss? All that stuff is extremely important, even more so than just reading price action, because that you could flip a coin and have good risk management and still make money. Like, let that sit in. Anyways, so I still think it's possible we could come back into this order block later into lunch. And I do think on the higher time frame, it is kind of weird that, let's go back to the 4-hour, that we're retracing back into the new week opening gap. Like, that's just kind of weird to me. We're disrespecting this breaker entirely. So going into tomorrow, I really don't know what we're going to have. Play it by ear. But I appreciate you guys joining. We'll wrap it up here. Definitely a longer stream today, I think. Live stream is super useful. I appreciate the kind words. Thank you guys. Yeah, hopefully you got something out of it, both psychologically, risk management wise, and tape reading. Hopefully I can see you guys tomorrow based on a good day. I'll decide if we want to stream or not. I'll send out a ping as usual. So journal, do the work that's necessary to succeed. Don't hold yourself short. Get outside and enjoy it if you can. Do the things that really matter. And I'll catch you guys soon. Peace.